As we all know that due to corona declared as pandemic and due to the lockdown declared by the government, Vigyan International Junior College has decided to provide online classes to the students. So I am Gauri Shankar Sarma, faculty of Vigyan College, providing you the classes from today online through my YouTube channel. So let us start the classes with final accounts. So final accounts or financial statements, these are the statements or accounts which are prepared by a business concern at the end of the year. So what are the financial statements they are prepared as final accounts by a business concern? First one we can say trading and profit and loss account, or we can say income statement. The other name of trading and profit and loss account is income statement. And this income statement is prepared in two parts. First part is trading account, which is prepared to know the gross profit or gross loss. Second part of income statement is profit and loss account. And this profit and loss account is prepared to know the net profit or net loss of a business concern at the end of the year. Why this income statement is prepared? Because throughout the year you are doing a business and you want to know the result. What is the amount of profit earned during the year, or what is the loss suffered by you at the end of the year? You want to know. That is why trading and profit and loss account is prepared. And what is second statement that is prepared under final accounts or as final accounts? That is balance sheet or positional statement. Why it is called positional statement? Because it tells about the financial position of the business concern. It is called positional statement. So as every person has a financial position, a business has also its financial position. So at the end of the year, on a particular date, on the last date of the accounting year, we prepare balance sheet to know the financial position. Okay, so let us discuss about trading account first. That is the first part of income statement. Come here. Trading account is the first part of income statement which is prepared to know the result of trading. Trading means, we have already studied it in BSM, that means Business Studies and Management. Trading means buying and selling. So why we prepare trading account? Trading account is prepared to know the result of trading. That means from buying and selling, what is the profit that has been earned by the business or loss suffered by the business due to buying and selling only. So what is the result it shows? It shows either gross profit or gross loss. It shows either gross profit or gross loss. It is the first part of income statement. Let us know how to prepare a trading account. As you have already learned about how to prepare ledger accounts, it is just like ledger accounts. It is an account. It has two sides. Left side is the debit side, right side is the credit side. And trading account, two columns on each side. For first one for particulars, second one for amount. Like this, on both sides there are two columns. So let us see what are the items they are recorded on the debit side and what are the items recorded on the credit side. debit side you can see opening stock, purchases, less returns, and purchases minus return, that is called net purchases. To direct expenses, and here on credit side by sales, sales less returns, that is called net sales. It is net sales. And then after net sales by closing stock. And finally, if credit side exceeds the debit side, the difference will be the gross profit. And if debit side exceeds the credit side, that is the gross loss. Why it is like this? Because we know it is a nominal account. As we are calculating profits and loss, profit and loss we are calculating, it is the incomes will be recorded on the credit side and expenses will be recorded on the debit side. So what happens in trading account? We are comparing the income that is earned from sales with the cost of goods sold. So sales income, the income from sales is here on credit side, and on debit side we are recording the cost of whatever the goods we sold. So first one, opening stock. Why we have taken opening stock? Because we have it doesn't mean that all the goods that have been sold during the year, that is from the purchases made during the year, that may be made, that sales may be made out of opening stock also. So the cost of opening stock we have to take first. So opening stock, then purchases less returns, and that is net purchases. And purchase also cost, because we are selling the goods that has been purchased during the year also. So next, direct expenses. What do you mean by direct expenses? The expenses which are related with either purchase of goods or production of goods. So here, as it is trading account, the expenses related to purchase are direct expenses, and these are recorded on the debit side. When you make total of all these expenses, that will be the total cost of all the goods. And it may not happen always that all the goods have been sold out during the year. There may be certain quantity of goods which remained unsold, which is called closing stock. So we are comparing here net sales with cost of goods sold. It is the total cost on the debit side. And out of total cost, when you will deduct closing stock, then you will get cost of goods sold. That is why instead of deducting the closing stock on the debit side, we have recorded it on credit side. So now when you will compare both sides, credit side is the income side, debit side is the expenses side. When income exceeds the expenses, the difference is gross profit. And if the expenses side exceeds then income side, then the difference will be gross loss. So in the next class we will discuss about the direct expenses. What is direct expenses and what are the examples of direct expenses, and how to prepare trading account. So we shall take an illustration in the next class. Okay, thank you. Follow the class properly.